I'm Craig Popp with Accrue Wealth, and this is Charts That Matter. Today, I want to briefly walk through recent economic developments, specifically around the labor market, stock market performance, and inflation, and what they might mean for the Federal Reserve and broader economy. Let's start with the labor market, which is showing signs of cooling. In August, only 22,000 new jobs were added, well below the 75,000 economists had expected. That brings the average monthly gain this year to just 75,000, down significantly from 168,000 per month in 2024. What is more concerning is the downward revision of past reports. June's figures were revised again, showing the economy lost 13,000 jobs, marking the first monthly job loss since 2020. Despite all this, the unemployment rate remains low at 4.3%. Fed Chair Jerome Powell recently described the labor market as being in a curious kind of balance, with both hiring and job seekers decreasing. This slowdown increases the likelihood of Fed rate cuts. In fact, market expectations now price in rate cuts at each of the remaining 3 Fed meetings this year, as the Fed tries to strike a balance between slowing inflation and supporting employment. So, with a cooling labor market, why are stocks near all-time highs? It may seem counterintuitive, but markets often rise on expectations, not just current data. Right now, investors believe that weaker jobs data increases the odds of rate cuts, which is typically good for stocks. Also, while hiring has slowed, it's important to remember that unemployment data is a lagging indicator. Other metrics are strong. For example, GDP grew at 3.3% in the second quarter, which exceeded forecasts. And 80% of S&P 500 companies reported better than expected earnings. These are positive signs for market fundamentals. So while the labor market is softening, corporate strength and growth momentum are keeping investor sentiment high. Finally, let's look at inflation, particularly the possible impact of tariffs. In July, the Producer Price Index jumped 0.9%. The biggest monthly rise since mid-2022, pushing the annual PPI to 3.3%. That suggests cost pressures are building at the production level. On the consumer side, inflation rose 0.2% in July, with annual inflation at 2.7%. One red flag, consumer goods inflation accelerated to 1.2% year over year, after a long period of deflation. This could reflect early signs that tariff costs are being passed along. At the same time, service price increases are slowing, though shelter costs remain elevated and gas prices are down 9.5% year over year. Still, core CPI is at 3.1%, and a super core measure, excluding shelter, is at 2.6%. These levels remain stickier than the Fed would like, complicating the path to rate cuts. To summarize, we're seeing a slowing labor market, strong corporate earnings, and inflation that remains stubborn in some areas. These cross currents make it likely the Fed will cut rates, but also likely will do so at a modest pace.